Well, the Bank of Canada announced today that it's lowering its overnight lending policy rate by 0.25%, bringing it down to 4.5%. So what is this going to affect? It's going to affect your variable rate mortgages and your home equity lines of credit, and may have an indirect effect on fixed rates moving forward. But of course, fixed rates are priced off of the Canada bond yield, so that is a totally separate thing. But here are 4 key takeaways I got from today's presser with Tiff Macklem, the governor of the Bank of Canada. Number 1.
Looking ahead, we expect inflation to moderate further, though progress over the next year will likely be uneven. This forecast reflects the opposing forces affecting inflation. The overall weakness in the economy is pulling inflation down. At the same time, price pressures in shelter and other services are holding inflation up. We are increasingly confident that the ingredients to bring inflation back to target are in place. But the push-pull of these opposing forces means the decline in inflation will likely be gradual, and there could be setbacks along the way.
What Tiff's saying here is that the path forward isn't necessarily going to be a downward slope when it comes to inflation prints next couple of months. Economic weakness is dragging inflation down. However, housing costs and renting costs are driving it up. So it could be an imbalanced move as we go forward. Here's number 2.
Economic growth in Canada has picked up, but remains weak relative to population growth. Household spending has been soft. Pent-up demand for things like new cars and travel is fading. And many families are setting aside more of their income for debt payments, leaving less money for discretionary spending.
As Tiff mentions here, economic growth is weak. We can feel it around us. The people that you know, I know, even us personally, we can feel the economy is on weak legs, and we probably are affected by that directly, or we know people who have been laid off or are likely going to be laid off soon. The economy is growing weak. Also, household spending is soft, and all through this presser, he had mentioned multiple times, household spending is declining. It's slowing down. Why? Because people don't have the money to make extra spending purchases in their household budget every month because times are getting so tough. Costs are through the roof, and people are really watching what they're spending, and that trickles into the economy. People aren't buying cars. They're not buying trips or local vacations, or even the real estate market we've seen has declined in sales. So spending is slowing down. Here's point number 3.
Looking ahead, economic growth is expected to increase in the second half of 2024 and through 2025. This reflects stronger exports and a recovery in household spending as borrowing costs ease. Business investment is also expected to strengthen as demand picks up, and residential investment is forecast to grow robustly. Overall, with the economy strengthening, excess supply will be absorbed next year and into 2026.
You'll notice here that Tiff makes mention of economic growth moving forward. Why? Because rates are going to have to come down. He didn't say that exactly, but what he's projecting here is the rest of 2024 and into 2025, we will start to see more economic growth and start to see households spend more. There's that little nod to the household spending again. Households will start to spend more. Well, why? Because rates are lowering and their cost of borrowing money, not just mortgage costs, but credit cards and lines of credit, car loans, all of these things will start to mean that Canadians will start to have a little bit more money to now spend in the economy. So looking forward to end of 2024 and even end of 2025, moving into 26, those mortgage renewals will be coming up, lower interest rates coming into renewal as opposed to today, and also economic growth helping the average Canadian spend a little bit more. Here's point number 4.
As always, there are risks around our inflation outlook. Globally, geopolitical uncertainty is high. Here in Canada, the biggest downside risk is that household spending could be weaker than expected. On the upside, inflation in shelter and other services could prove more persistent.
You'll notice here Tiff makes a reference to global issues. There's no big secret that there's a lot of global tension right now. And we have a major election coming up south of the border to Canada. And depending on who's going to be going into office, into the Oval Office, it could be a push towards a more aggressive stance on global issues or a more domestic stance on global issues. He also talks about that household spending again. So the message here that I'm getting from the governor is it's too hard to tell how low rates are going to go or how fast because there's so many different things at play. Usually global tension and global issues, meaning WAR, would end up stalling an economy quicker, meaning households are spending less and thus having to lower rates quicker in times of tension because people are just not spending and the economy stalls out. On the flip side, he does mention that household costs, shelter costs, meaning mortgage, shelter costs, or even rental costs, remain high. And that pushes that CPI number up still. So what the message I'm getting here is this: we're going to have this up and down wave slowly moving down, but he's basically signaling, hey, we don't really know the path moving forward. We're hoping it's going to be down, and we hope that we're going to do steady decreases, although he didn't say that outright. But the message here is clear. Household spending is looking really bad, which means the economy is stalling. But on the flip side, shelter costs are still high, and there's global issues involved in all of this too. So the messaging from Tiff today, lowering rates by 0.25%, bringing that overnight lending rate down to 4.5%. Remember, just at the beginning of June, it was at 5%, but we had a rate decrease in June and another one today here in July. So now we're at 4.5% for that overnight lending rate. Message is very clear. We don't really know how this is going to look. We're hoping we're going to march this rate down for the rest of this year and maybe into next year to the end of 2025, which will help boost the economy. But still murky messaging here on the actual path. But what is clear on multiple occasions made in this presser, what is clear is household spending in Canada is on the decline. People are feeling the pain. Unemployment is up. And the soft landing that they consistently keep talking about might not be here. You know, if we continue to see big employers pulling out of development or firing or letting go, laying off employees, that can have a downward impact on the economy, which is a double-edged sword. Downward on the economy means they've got to lower rates, but those shelter costs still remain high. Anyway, hope you found this useful. If you have, go ahead and give me a like and subscribe to the channel if you can. Always helps us build our audience and helps with the algorithm juice here on YouTube. So thanks so much for watching. And if you found that interesting, maybe you'll want to watch this next video. All right, take care. Bye-bye.